want to talk a little bit and shift gears now about what I think is also a very emotional part of meeting our retirement challenge, which is investing some of our monies. A lot of folks today are not going to be able to get there by saving enough cash to get there, right? Most of us are going to need some type of help from an investment. Nathan, you've talked in lectures also about this idea of how we react as consumers to losses and gains. Can you walk us through this model and talk about how that would apply also to us from a savings or investing standpoint?
Sure, Mike, I'd love to. So the graph you're all seeing is a complicated way of saying something that's fairly intuitive, perhaps, once you say it, which is losses hurt us more than gains feel good. For example, losing $10 seems to matter more to us than gaining $10. That's just the way we're built. It's something called loss aversion. It's been around now for a while. Behavioral science has definitely shown that it's true. What does this mean for investing? What this means for investing is, for example, if you invest in most things like stocks, equity, funds of all kinds, they're going to go up and down over time. The problem with loss aversion is as they're going up and down, the downs we're really going to feel, and we might feel more than the ups. And what that's going to do is that's going to lead us to be more risk averse than we probably should be. And so one simple idea to solve this particular kind of risk aversion is not to look so often. Literally not to check every day. If you're in a retirement account, you're probably in a buy and hold situation. And so the value of that thing doesn't matter to you tomorrow. It doesn't matter to you next month. It doesn't matter to you in a year. It matters to you many years from now. And so looking at it every day and seeing whether it's up, whether it's down, and making yourself worried and nervous because you see those paper losses can cause people to pull back from what we know are good investments, but good investments tend to go up and down a little bit. That's just the nature of the business. And so being able to realize, look, I'm a little loss averse. I get a little too caught up in losses. I'm not going to look so much. I'm going to look when I have to. Now, for retirement savings in particular, because it's such a long time horizon, that really is, I think, the right answer.
So to sort of caption what you said, people are generally more upset when they lose than they are excited when they win.
Yes.
And so that can really translate longer for us when we see the downs in our portfolio. So we want to make sure that we're treating it as a long-term objective.
Exactly, because one of the nice things about, for example, stocks is over the long term, you're going to see fewer losses, right? So we know these things go up and down over days, but over months and years, the stock market tends to go very reliably up. And that's what we're trying to capture in our retirement portfolio, is that up that it's getting. But if we psychologically look day to day, we're going to feel some things that aren't actually financially relevant to us. If we're investing in the long term, let's only look every now and then and say, is my portfolio allocated the right way? Not, is it gone up or down today? Oh, how much did I gain? I saw that the news report made, did my retirement balance go up? Did it go down? That kind of up and down is going to make us feel things that we don't need to feel. And those feelings are going to make us probably more risk averse than we should be, and we're not going to enjoy the gains that the stock market could give us if we would just be willing to back off and say, look, I don't care about day to day. I care about year on year or even decade on decade gains, and those rarely go down.
Okay, sure, great. So Farnoosh, to Nathan's point, I wanted to go back to something you talked about earlier. And you also talk about this in your book, Psych Yourself Rich. The events of 2008 were very emotional for a lot of people. We had the credit crisis followed by the severe market downturn, and it was sustained. And at that point, a lot of people abandoned ship. They sold out of their investments, possibly at the worst time. And it carried through for a number of years for a lot of folks who missed out on a lot of the recovery. And we still have people telling us today, I got out and I stayed out, and I might have missed out on some of that recovery. Some people even stopped saving because they were automatically investing in an IRA or 401k. You also talk about some common approaches here to investing for a long-term goal. And I thought maybe you could walk us through these in light of something that is a short-term extreme event like the 2008 situation, and maybe talk to us about how this can help someone sort of from a mental standpoint or an emotional standpoint weather some of that short-term volatility.
Sure, happy to. So I think really the bottom line is to think of retirement planning as a marathon. It's not a sprint. You're not sprinting to the finish line. To Nathan's point, you shouldn't be obsessively looking at your statements every single day. Once a quarter is healthy, twice a year. So along the way, I think it's important that you maintain certain principles when it comes to your approach, your investing approach, and your behavior towards investing. One is, of course, course, to diversify. That is, we've heard this before, diversification is absolutely key to the health of your portfolio, to manage downside risk. Understand that the market is volatile, and there are certain things that are completely out of our control, but what we can control is the diversification of our assets. So making sure that you're spread across a healthy balance of equities, bonds, fixed income, CDs, things like that, so that, and you're not all, like, say, invested in one particular stock heavily. We saw that happen a lot in recent years, where people were all in their company's stock, or 50% invested in their company's stock. And of course, we know what happens when the company goes under, so does your portfolio. So mixing it up is very important. Mind your risk appetite and your retirement horizon, very important. If you are a 20-something looking to retire in 40 years, you have a very long retirement horizon. You can probably have a bigger appetite for risk, as opposed to somebody who is 55, nearing retirement, maybe just 10 years left to go. You don't want to be too heavily invested in the stock market. The rule of thumb that I've read a lot is that you take 100, you subtract your age, and that is the equivalent percentage of what you should be invested in equities, in stocks. So if you're 35, maybe you want to be 65% invested in equities, and not like individual stocks, but mutual funds and trade index funds and things that sort of bundle these stocks for you nicely and neatly. Average out the cost of investing over time. What does that mean? You don't want to get a lump sum of money, put it all into your portfolio one fell swoop. You want to sort of average it out over time, again, to better manage your downside risk. So if you have $10,000 that you want to invest this year in retirement, don't just put it all right away don't invest it all right away. Kind of space it out, maybe do $1,000 a month, slowly, to kind of, again, really what that does is it manages your downside risk. Avoid knee-jerk reactions. We talked about this earlier. Lots of people did the opposite during the recession. They fled their 401ks. They stopped investing. We have recency bias, which is another behavioral trip up. We feel as though what's happened most recently in the context of our lives is all that we sort of focus on, that we obsess about it, forgetting that, over historical periods of time, the market has actually done quite well. But we tend to just kind of focus and obsess about the fact that, last year the market was down X%, or that our house has lost equity. But you got to think about sort of like the longer run and the longer term and historical reference. And then finally, time is on your side, especially for young adults. I mentioned this. I say, youth is not wasted on the young. One of the best assets that you have now is time. And you can afford to really ride out the volatility. And the earlier you start to invest, the more likely you will end crossing that finish line with flying colors.
So to that point, I think time is so important in this whole equation. As far as someone's mindset here, knowing that there are going to be some ups and downs along the way. What about for someone who's getting closer to retirement? They might still need growth, but they might also be concerned about market declines. Is there a balanced approach there?
Sure. So I think there's this myth that as you're approaching retirement, you should be completely out of the stock market, that you don't want to take on any more risk. But remember that, while you might leave your job in your 60s, you're not going to take out all that 401k money or all that IRA money at once. It's going to continue to stay invested during your retirement. So at the same time, you don't want to be 80% in stocks. I think, again, going back to that rule of thumb where you take 100, subtract your age, and that's kind of the maximum percentage you want to be invested in something aggressive like equities. But diversification is still really important, even as you're approaching retirement. You don't want to be all in one bucket or the other. Yes, growth is still important at that stage, but you don't want to be, perhaps in emerging markets where, it's highly exposed to volatility. You want to make sure that you are rebalancing your portfolio to really match the fact that you're going to retire quite soon, and that you don't want this money, you don't want to be throwing darts at that point.
So you want to look through, not just to retirement.
Exactly.
That's a saying.
That's a good way to put it.